Good morning, everybody. This is Brian Dewhurst with Uncommon Wealth Partners, bringing you your month-end market update and Bitcoin briefing. Have so much to share. Man, a lot happened in the last 2 weeks since the last time I posted, so I can't wait to get into it. We're going to go quick today. Markets have just basically been choppy. You can see the returns there. The Dow and the S&P pulled down a little bit. NASDAQ's sitting pretty close to all-time highs. Gold has pulled down and Bitcoin has gone up. So want to get into some news today first to set the stage before we get into the charts. But before I get into all that, smash up the likes. I just want you to smash up the likes, subscribe. Just so excited about the content we're going to be bringing you in 2018 and just want to continue to deliver value. So I hope you find this information enjoyable. And please reach out to us if there's anything you want to see. I'm open to that. And just smash up the likes. Love it. All right, 2017, our federal deficit. So looking at the money the government takes in taxes and the money the government spends in pretty much everything, the U.S. had a deficit of $666 billion. So that's like if you and your wife, looking at your annual budget, you didn't make it, you had to put $666 billion on a credit card. That's exactly what happened in 1 year. That's how much we spent beyond what we took in. So if you think about the government as a business, it's losing a truckload of money. So we got the tax cuts from DT, Donald Trump and the gang, and this just came out. Now they're projecting the deficit this year in 2018 to eclipse $1 trillion. And I could not find the article I saw this on, but I thought I saw it where one of the people in the comptroller's office who manages this stuff was estimating it at 1.25 trillion. So almost a full 100% increase in the federal deficit. So I just think that is so important. And then when you look at the fact that our federal deficit already is approaching 21 trillion, it's conceivable that we could easily be at 25 trillion in national debt by the end of Donald Trump's first term. And I saw he just announced that he's ready to run for a second term already. So glad he gave us that heads up. We'll keep it non-political from there. Having a nice picture of this yellow bird. But so my point with all this is our government is out of control. It's just out of control. They're spending over $1.25 trillion we don't have every year, and the pace is doubling in the wrong direction. And so you're seeing a lot of the market undulating, and you're hearing the new Fed president talk about how healthy the economy is and how they're raising rates, basically to slow down inflation and so things don't spin out of control. And we've kind of talked about this in past videos that the Fed has printed just a truckload of money. Evidently, I like the word truckload this morning, and so has every other government, by the way. So we're not alone. So this is saying that the economy is strengthening, and Fed's Powell suggests faster pace of interest rate hikes. I saw a recent article saying that we could potentially raise rates 4 times this year. This is a huge myth that I want to dispel right now. They do not raise rates because of the economy strengthening. That makes no sense. That is a complete fallacy, and that's what they want you to believe. And so what they're doing is they printed a ton of money out of thin air to bail us out of the 08-09 crisis and pretty much did exactly how or what got us into that crisis. They did it again. And the reason they have to raise rates is because people don't want to hold the dollar like they used to. And the people that actually buy the U.S. bonds are saying, we're not going to buy these if you don't raise interest rates. We're not going to, give you trillions of dollars of money when you're running $1 trillion deficits annually, and you're going to pay us less than 1 or 2% interest. So interest rates go up to support the value of the dollar, and that's it. And it's just a confidence thing. And so I wanted to show you this again because I've talked about it before, and we're going to keep talking about it. But China is opening up their own oil trading futures contract to trade oil in yuan. That's their currency, because China is trying to assert their currency on a global scale and saying, basically, U.S., we are not going to finance your deficits anymore. So oil, for the last 25 years, in every corner of the world, in every transaction, has been settled in U.S. dollars. And that, think of it as supply and demand. There's just a ton of demand for US dollars. And so it's artificially, inflated the value of the dollar globally. That's ending. This futures contract goes live this month, March 26th. So what I'm trying to show you is this undulation in the market is the market trying to digest the shift in interest rate policy, the shift in the value of the dollar, and the global shift that's happening as more and more countries challenge the dollar supremacy. And then not only that, you have gold playing into that, and you have cryptocurrency. So we are changing paradigms, in my belief, and it's all about currency, and it's all about debt and interest rates. And the market is trying to digest this. And so that's where I think you're seeing undulation in the stock market, is because of these headlines. So this is another just really compelling chart. This is the federal debt held by the public. So this is the national debt, and then you see percentage of GDP. We're approaching 100% of GDP. So basically every dollar that's produced in this country is going to be backed by a dollar of debt. That's typically a pretty big warning sign. Like Japan is at, I think, like 121%. So we're approaching that. And especially when you look at the baby boomer class as they go on Medicare and they start drawing Social Security, it's only going to put pressure on the federal deficit. But they think that we, the public, that's on us. In the form of taxes and inflation. So the value of the dollar is going to come into pressure, and we're going to talk about that. But this chart, I don't have it cited, but this chart was from the Comptroller's Office of the federal government. So very staggering. And you see how just in the last when you look at this chart from in here, mid-2005, we're at 40%. I mean, just think about it. That's only been 12, 13 years. And now we're almost at, approaching 100%. Over the next several years. And so this thing is spinning out of control rather quickly. And that's why I think you've got to own other assets. And that's why Philip and I focus on our podcast of having multiple streams of income. So we're going to keep beating that drum. These are alarming charts, and I think you need a plan forward. So this is the chart of the US dollar. Look down below here. You can see this goes way back into the 70s. And you can see the value of the dollar was largely supported. You remember in here when interest rates went sky high, that supported the value of the dollar, because people are like, yeah, shoot, I'll give you money if you're going to pay me 15, 16, 17% interest on treasury debt. And now over the last 30 years, we've seen a downturn in not only interest rates, you'll see that chart in a minute, but this is just the value of the dollar. And so the dollar here, what you see here on this chart, this just went straight up. Well, that means that it can kind of go straight down. And we kind of talked about the S&P 500. When things go straight up, they can also come straight down. So the dollar, in terms of the chart, has broken support here, and it's coming down. And so you're seeing it try to make a very short-term rally as the Fed is going to try to increase interest rates to support the value of the dollar, because they don't want it to drop down here towards 70 again. So that's kind of what's happening. That's why interest rates are going up. So this is from the Fed. This is the Federal Reserve Economic Data. Really great website, by the way, if you ever want to do research, and it's free. So this is the interest rate chart going way back. You can kind of see here in the 80s or the late 70s, early 80s, how interest rates peaked. And I just showed you previously how that impacted the value of the dollar. The dollar kind of lagged that. And then the dollar chart was like this. You see the interest rate chart like this. And this is that 25 years of the petrodollar supporting the dollar, essentially, and allowed us to drop interest rates and print money. And that's why you saw the federal deficit chart exploding. So now we had interest rates really flattened out in here. We've been at 0%. And now we're starting to see interest rates tick up because they've got to go and support the value of the dollar. It has nothing to do with the health of the economy. It has everything to do with trillion-dollar deficits, 10,000 people a day turning 65, drawing Medicare and Social Security, and we are functionally broke as a country. So this is a big deal, and don't let these interest rate rises fool you that it's because the market is healthy. Now, I do think the stock market is healthier. These companies are making record profits. Interest rates are still historically low. Jobs are picking up. I think unemployment now is at the lowest it's been in 10 or 20 years, which is great. And we're seeing wage growth, right, from the tax cuts. Multiple companies sharing they're going to raise wages and stuff like that. We're hearing from our clients that they're taking home more money a month. So that's at the expense, though, of our national debt, mind you. But it is helpful in terms of that. So anyways, wanted to cover all that before we jump into the charts, because I do think the market is looking a little choppy here. And I think it could continue to look choppy as the market digests a new Fed chair. He's actually testifying today in front of Congress and digesting this news about China and the oil settling in won, not only in terms of settling in dollars. So there's just a lot going on, and the market has to digest that. And we're at or near all-time highs, and so there's just profit taking too. So you see on the monthly chart, we're on the spider. The market's still healthy. It's looking. We haven't had any red candles yet, although I think we could probably see one potentially in March on the monthly. And again, I think long-term, we've seen that before, but it still was the right play to stay invested for the long term. And so we're monitoring this, and we're going to keep shooting these videos. But on the monthly chart, still 6 green dots, and everything's still potentially looking healthy there. On the S&P, this is our other chart. We still have green candles in here on the monthly, so that's looking like it has. We haven't seen a change in trend on that yet, so we'll continue to monitor this chart as well. But that looks like it has in the past. And now our moving averages chart, you still see it looks healthy. Everything's fanned out. I do think you can kind of see how these lines, I don't know what you to describe them as, but they just kind of look stretched, like, oh, we got to pull back a little bit. Think about them as kind of like elastic bands, and they're stretched to the point. They're too far, and I think they're going to give. So I think the market could give some money back here. But as you saw, even in 2015 and 2016, as we gave some back and we traded sideways, these averages didn't break, and it made sense to stay invested and continue on to the long term. So I think, again, putting this in perspective, we do anticipate some short-term volatility, but I wouldn't panic because structurally things, in the economy are still good. And one of the best hedges to inflation and the instability of the federal government is businesses that produce cash flow. And one of the best ways to be leveraged to that is the stock market. Not only to own your own business, not only to own rental properties and other assets that produce cash flow, as Philip and I talk about regularly, but the market is a good hedge against inflation. It is a good hedge against instability because companies keep filling up the grocery store. We have to keep doing those things. And over the long term, those things go up. So let's keep going here. This is gold. Gold monthly chart is looking a little red in here. We had a big kind of pullback in gold in the last few weeks as this kind of, the headlines are saying that the economy is great and all this stuff. That can have an impact on gold. I do think the long-term trend in gold is going to continue to trend upwards, but we've seen some weakness in the last 2 weeks since our last video. And the S&P 500, I wanted to show you the daily chart on the S&P 500 because it's going to show you a lot more of the volatility. And now you can see in here just how far we fell, just about over 10% from the peak to the bottom there. You see that the green arrow picks up because we hit this bottom bumper. And so that weakness. But I think you could see the market come down here again. I think it would actually be healthier long term if the market could put in a little bit of a double bottom here on the daily. So it would go up, come down, hit this kind of support line in here, maybe even come down in here where there's a lot more support. And then it would go, bounce back up, and we'd go on to probably set newer highs over 2018, 2019. So it just kind of depends on how much time it takes to shake out of all that. But normally, once a year, the market pulls back 10%. So we've had that. So that's not scary. That's normal. I talked about in the last video, we had 404 days. The market didn't pull back even 3%. So this stuff is healthy. We've gone up a lot. We need to come back to consolidate our gains. We've talked about that in order to set new highs. And so nothing out of the ordinary here, but would expect to see potential more weakness in the major markets, stock markets. So with that, now on to Bitcoin. 2 massive news articles in the last 2 weeks. I had to cover them. Circle acquisition of Poloniex is just the beginning of likely consolidation in crypto. The bigger part of this that actually doesn't capture it on the headline, what a bunch of other headlines did, is that Circle is co-owned or partially owned by Goldman Sachs, one of the most storied Wall Street investment firms, over the last 100 years. And so when you're looking at this, the fact that a big Wall Street bank and one of their subsidiaries or investments bought a cryptocurrency exchange is a very telling sign of what's happening. Then immediately, I think after that, nope, it was before this. So Bank of America came out first, then the Poloniex. Bank of America. So publicly traded companies, as part of their compliance and disclosures to the SEC and to regulators and all that, they have to disclose material threats to their business. Well, Bank of America came out and basically said that they now view cryptocurrency as a material threat to their business in their financial reporting statements. So huge development here. The two biggest banks in the country are sounding the alarm that they have got to address cryptocurrency. It is here to stay, and it will have a material impact on their business. Further, I've detailed in the past that the blockchain, the actual ledger that supports cryptocurrency, it's like the accounting, is going to be used in healthcare, retail, logistics. It's going to be in everything because it's just better. It's just like the internet was. It's just take time to flush out these adoptions and things that it can actually benefit society with. It's just going to take time. And so with that, when you look at cryptocurrency as money, I do think it is money, especially Bitcoin. Some of these other cryptocurrencies I don't know about, but Bitcoin for sure. The industry that it's going to disrupt the first is banking and the stock market, because there are exchanges you can trade these coins. Many platforms now allow you to lend against your cryptocurrency like a bank does. You can put your cryptocurrency on deposit and you can take loans against it. And that's tax-free income. You don't actually pay tax on that. So there are just a massive amount of applications coming. I think it's going to disrupt the financial services industry first. And as a business owner in financial services, I have to understand that and address that. And I think, obviously we've talked about the gains and these coins have gone up. I can't ignore that either, being uncommon. So we're going to continue to talk about cryptocurrency. Massive companies are now making very big statements, and Bitcoin has been way down. So let's cover that. Let's get into the chart. So this is the all-time high of Bitcoin right here. It was a hit, almost touched off at 20,000. And then this has been the precipitous decline that we've been covering. And now the last week I did this chart, I drew a couple arrows. It would go up, it would bounce down, and then it would go up. And that's exactly what happened. And we have now broken through this resistance on the daily chart. And I did a quick snapshot. I didn't take it as a screenshot, but the weekly chart, it broke out as well. So I think we could continue to see it bounce around. But the Chinese New Year has now ended. So China has been on vacation for the last couple weeks. And I think you're going to see a renewed interest in cryptocurrency as they come back. Further, you have tax season ending. So a lot of people taking gains and paying taxes. We're going to be through that. And I think, when you see futures contracts, they end on the 15th of the month. I think, in the next 2 months, we could see a lot of support into cryptocurrency. So if you still haven't jumped in or you still have tons of questions, please reach out to us. We are not scared to talk about it. And again, we do it in the context of an overall plan. And we do it in context of very small amounts of money. And kind of like, I'm going to continue to use this analogy. It's like that first computer you bought in the 90s. You didn't really know what it was going to do. It didn't really do a whole lot, let's be honest. And it took forever for it to do anything. Cryptocurrency is in that phase. It's like 1994, it's 1995, and you just got your first desktop computer. And you probably spent $1,000 to $1,500 on all that stuff. So that's where I would start. If you haven't taken a plunge into cryptocurrency, take a very small toe, but this is not going away. And the news articles from Bank of America and Goldman Sachs are proof of that. And so, again, I bid you adieu. That was your market update, and hope this was informative. And if you please have questions, reach out to us, and looking forward to hearing from you. And smash up the likes. Thanks, everybody, and we wish you an awesome March. The material in this video has no regard to the specific investment objectives, financial situations, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell a security or any other related financial instruments. Nor should any of the content be taken as investment advice. Any of the opinions expressed in this video are subject to change without notice, and Uncommon Wealth Partners LLC is not under any obligation to update or keep current the information contained herein. Uncommon Wealth Partners LLC and its respected officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. Uncommon Wealth Partners does not accept any liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.